Something extraordinary is happening in the gold market right now, and most people have no idea what's coming. For the first time in history, gold is trading in a zone where there are literally no resistance levels above it. No technical barriers, no historical price ceilings, nothing but open sky. Let me explain what that means and why it matters more than any gold move you've seen in your lifetime. When a market breaks into uncharted territory with no resistance, it's like a dam breaking. There's nothing to slow it down. No previous sellers waiting at higher prices. No psychological barriers where traders think, that's too expensive. Just pure momentum and demand pushing prices into levels we've never seen before. And here's what makes this different from every other gold rally. This isn't speculation. This isn't retail investors chasing a trend. This is central banks around the world buying gold at a pace we've never witnessed, while simultaneously the technical structure of the market is setting up for what could be the most explosive move in precious metals history. Think about what no resistance actually means. In technical analysis, resistance levels form when prices previously peaked and sellers overwhelmed buyers. Those levels act like ceilings. When gold approaches them again, sellers remember and often push prices back down. But when you break through all known resistance and enter virgin territory, there's no memory of previous selling. No one knows what's too high because we've never been here before. Gold just shattered through its previous all-time highs and kept going. It didn't pause. It didn't consolidate. It broke through, like those levels didn't even exist. And now it's trading in a zone where the next resistance level is literally unknown, because we have no historical data to reference. Let me paint you a picture of what's actually happening behind the scenes, because the mainstream financial media is completely missing this story. Central banks purchased over 1,000 tons of gold in the most recent year. That's the third consecutive year of purchases exceeding 1,000 tons. To put that in perspective, that's more gold than most countries have in their entire reserves. And they're not slowing down. If anything, they're accelerating. But here's where it gets interesting. These aren't just any central banks. We're talking about China, Russia, India, Turkey, Poland, countries that are actively working to reduce their dependence on the US dollar. They're not buying gold because they think it might go up. They're buying gold because they're preparing for a fundamental restructuring of the global monetary system. China hasn't reported their official gold reserves in months, which historically means they're accumulating far more than they're willing to disclose. Russia has been converting dollar reserves into gold for years. Even countries that were traditionally dollar loyal are now diversifying into gold at unprecedented rates. And here's what nobody's talking about. These central banks aren't buying paper gold. They're not buying ETFs or futures contracts. They're demanding physical delivery, actual bars of gold that they're storing in their own vaults. That distinction matters more than you might think. The gold market operates on two levels. There's the paper market, where contracts representing gold trade back and forth, often with leverage of 100 to 1 or more. Then there's the physical market, where actual metal changes hands. For decades, the paper market has dominated price discovery. But something's shifting. When central banks demand physical delivery, they're draining actual metal from the system. And unlike paper contracts that can be created with a keystroke, physical gold has to be mined, refined, and transported. There's a finite supply, and right now, demand for physical gold is overwhelming available supply. The COMEX, the major exchange where gold futures trade in the United States, has seen its registered inventory, the gold actually available for delivery, drop to levels that would have been unthinkable just a few years ago. We're talking about enough gold to cover maybe a few days of delivery demands if everyone who owned a contract actually wanted their metal. Now, most futures contracts get rolled over or cash settled. People trade them for profit, not to take delivery. But what happens when more and more participants start demanding physical? What happens when the ratio of paper claims to actual metal becomes so extreme that confidence in the paper market breaks down? That's the scenario that's quietly keeping people awake at night in the gold trading world. Because if we ever reach a point where delivery demands exceed available supply, the price of physical gold could decouple from the paper price entirely. And we're seeing early signs that this might already be happening. Premiums for physical gold coins and bars have been elevated for months. Dealers are struggling to source inventory. Mints around the world are running at capacity and still can't keep up with demand. Meanwhile, the paper price, the price you see quoted on financial news, doesn't fully reflect this physical shortage. This creates an arbitrage opportunity that's too good to ignore. If you can buy paper gold and convert it to physical, you can capture that premium. And sophisticated players are doing exactly that, which puts even more pressure on physical inventories. Now let's talk about what's happening technically, because the chart structure is absolutely remarkable. Gold has broken out of a multi-year consolidation pattern. For years, it was trapped in a range, building energy like a coiled spring. Every time it tried to break higher, it got pushed back down. Sellers would emerge, profit takers would cash out, the rally would stall. But this time, when gold broke through that resistance, it didn't look back. It powered through levels that previously acted as ceilings like they were made of paper. And now it's in a position where the next logical resistance level is purely psychological, not technical. When markets enter uncharted territory, they often move much further than anyone expects. There's no reference point for what's expensive, no previous peak where traders think, this is where I should sell. The only limit is how high buyers are willing to pay and how long sellers are willing to hold. And right now, the biggest buyers in the world, central banks, are showing no signs of slowing down. They're not trading, they're accumulating, they're building positions for the long term. That's the kind of demand that can push prices far beyond what traditional analysis would suggest is reasonable. Let me give you some historical context, because we've seen this movie before, just not at this scale. Back in the 1970s, gold was in a similar position. It had been fixed at $35 an ounce for decades under the Bretton Woods system. When that system collapsed and gold was allowed to float freely, it entered uncharted territory. There was no historical precedent for what a free-floating gold price should be. Gold went from $35 to over $800 in less than a decade. That's more than a 20-fold increase. And it didn't move in a straight line. It had explosive rallies followed by brutal corrections. But the overall trajectory was unmistakably up because the fundamental driver, a loss of confidence in fiat currency, was overwhelming. We're seeing echoes of that today. The US dollar, despite being the world's reserve currency, is facing challenges it hasn't seen since the 70s. Massive government debt, persistent inflation, geopolitical rivals actively working to undermine dollar dominance, and central banks around the world responding by buying gold. The difference is, this time the stakes are even higher. The global financial system is far more interconnected. Debt levels are far higher, and the tools that central banks used to manage previous crises, mainly lowering interest rates and printing money, are either exhausted or politically untenable. Quick aside here, because this is relevant if you're thinking about your own financial security. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It covers how to get physical gold into your retirement account without tax penalties, which is something a lot of people don't realize is even possible. It's in the description if that's relevant to your situation. Worth checking out. Anyway, back to where this price is headed next, because the technical setup is just one piece of the puzzle. The fundamental drivers behind this gold move are unlike anything we've seen in modern markets. This isn't just about inflation or interest rates or geopolitical tension. It's about all of those things converging at the same time, creating a perfect storm of demand for hard assets. Let's start with inflation, because that's what most people think drives gold. And they're not wrong, but it's more nuanced than just inflation goes up, gold goes up. Real inflation, the kind that erodes purchasing power, has been running far hotter than official statistics suggest. Anyone who buys groceries or pays rent knows this. The cost of living has increased dramatically, while official inflation measures have been, let's say, optimized to show more modest increases. This creates a credibility problem. When people stop trusting official inflation numbers, they start looking for alternative stores of value. And gold has been the ultimate inflation hedge for thousands of years. Not because it goes up in value, but because it maintains purchasing power while currencies lose theirs. But here's what's really interesting. Gold is rallying even as interest rates have been elevated. Traditionally, higher interest rates are supposed to be negative for gold because gold doesn't pay interest. Why hold gold when you can get 5% in a savings account? The fact that gold is surging despite higher rates tells you something profound about market psychology. It tells you that investors are more worried about the return of their capital than the return on their capital. They're prioritizing safety over yield, and that's a massive shift in sentiment. This shift is being driven by a growing awareness that the global financial system is far more fragile than most people realize. We've had multiple banking crises in recent years. We've seen supposedly stable institutions collapse overnight. We've watched governments step in with bailouts that ultimately get paid for through currency debasement. And smart money is reading the writing on the wall. They're looking at government debt levels that can never be repaid through taxation alone. They're looking at central banks that are trapped between fighting inflation and supporting asset prices. They're looking at geopolitical tensions that could disrupt global trade and financial flows. And they're buying gold. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with several other countries that have joined or are seeking to join, are actively working on alternatives to the dollar-dominated financial system. They're discussing a gold-backed trade currency. They're building payment systems that bypass SWIFT. They're creating institutions that compete with the IMF and World Bank. Now, whether these initiatives succeed or not is almost beside the point. The fact that they're being pursued at all signals a fundamental loss of confidence in the current system. And that loss of confidence is driving demand for gold as a neutral reserve asset that no single country controls. China is particularly interesting to watch. They've been systematically building their gold reserves for years, but they report their holdings infrequently, and many analysts believe their actual holdings are far higher than officially stated. Why would they do this? Because if China announced they had accumulated, say, 10,000 tons of gold, it would send shockwaves through the market. The price would spike. Other central banks would rush to buy, and China's remaining purchases would become far more expensive. So they accumulate quietly, reporting only when it's strategically advantageous. Russia took a different approach. They accumulated gold openly and aggressively, especially after sanctions were imposed following geopolitical conflicts. They converted dollar reserves into gold specifically to insulate themselves from Western financial pressure. And when additional sanctions were imposed, their gold reserves became even more valuable as a sanctions-proof asset. This is creating a feedback loop. As more countries buy gold to protect themselves from financial weaponization, it validates the strategy for other countries. And as the price rises, it reinforces gold's status as a premier reserve asset. We're watching a slow-motion shift in the global monetary order, and gold is at the center of it. Now let's talk about supply, because this is where the story gets really interesting. Gold production has been essentially flat for years. Despite higher prices, which should incentivize more mining, we're not seeing significant increases in supply. Why? Because the easy gold has already been mined. The gold that's left is deeper, lower grade, and more expensive to extract. It takes years to bring a new mine online. Environmental regulations are stricter, labor costs are higher, energy costs are higher, and the geological reality is that we're not discovering major new deposits at the rate we used to. This means that supply is relatively inelastic. Even if the price doubles, we can't just produce twice as much gold. The supply response is slow and limited. Meanwhile, demand is surging. Central banks buying, retail investors buying, institutional investors allocating, and supply can't keep up. This supply-demand imbalance is fundamental and structural. It's not going away, and it's one of the key reasons why gold in uncharted territory with no resistance could move much higher than traditional analysis would suggest. There's also the recycling factor. When gold prices rise, more people sell their old jewelry and scrap gold. This recycled supply helps meet demand. But there's a limit to how much can be recycled, and we may be approaching that limit. The low-hanging fruit, the old jewelry sitting in drawers, has largely been sold already during previous price spikes. Now let's talk about what happens next, because this is where it gets really interesting from a trading and investment perspective. When a market breaks into uncharted territory with no resistance, it typically goes through several phases. First, there's the initial breakout, which we're seeing now. Prices surge as the market realizes the old ceiling is gone. Early buyers who were waiting for confirmation jump in. Momentum builds. Then there's often a pause or consolidation. The market catches its breath. Some early buyers take profits. Skeptics point to the pause as evidence the rally is over. But if the fundamental drivers remain intact, this consolidation just builds energy for the next leg higher. The next phase is where things get explosive. The market breaks out of the consolidation and makes a run at new highs. This is when the real momentum kicks in. This is when people who missed the first move start chasing. This is when institutional money that was sitting on the sidelines starts allocating. And this is when prices can move far beyond what anyone thought possible. We saw this pattern in the late 70s. We saw it in the 2000 to 2011 gold bull market. And we're seeing the early stages of it now. The question isn't whether gold will go higher. The question is how much higher and how fast. Now, I'm not going to give you a specific price target, because anyone who tells you they know exactly where gold is going is either lying or delusional. Markets are complex systems with too many variables to predict with precision. But I can tell you what the setup suggests. When you have central banks buying over 1,000 tons per year, when you have supply constraints, when you have geopolitical tensions, when you have currency debasement, when you have a loss of confidence in the financial system, and when you have a technical breakout into uncharted territory with no resistance, the path of least resistance is higher, significantly higher. The risk isn't that gold goes down. The risk is that it goes up so much that you're priced out of the market. The risk is that by the time the mainstream catches on, the easy gains are gone. The risk is that you wait for a pullback that never comes, or that when it does come, it's to levels far higher than today's prices. This is why positioning matters. This is why understanding the difference between trading and investing matters. If you're trading, you need to manage risk carefully, use stops, take profits. But if you're investing, if you're building a long-term position in gold as insurance against monetary chaos, then short-term volatility is noise. The trend is your friend, and the trend is unmistakably up. Let me give you another historical parallel because it's instructive. In 2008, during the financial crisis, gold initially sold off along with everything else. People needed cash. Margin calls forced liquidation. Gold dropped from over $1,000 to below $700. But then something interesting happened. As central banks responded with unprecedented monetary stimulus, as governments ran massive deficits, as the scale of the crisis became clear, gold didn't just recover. It went on to make new all-time highs, eventually reaching $1,900 by 2011. The people who sold in panic during the initial crisis missed one of the greatest gold rallies in history. The people who bought during the crisis or who held through it were rewarded handsomely. The lesson is that in times of financial stress, gold's role as a monetary asset becomes more valuable, not less. We're in a similar setup now, except the imbalances are larger, the debt is higher, and the geopolitical tensions are more severe. If gold rallied from 700 to 1900 in response to the 2008 crisis, what might it do in response to the challenges we're facing now? And remember, we're starting from a much higher base. We're starting from a position where gold has already broken out. We're starting from a position where central banks are already buying aggressively. We're starting from a position where the technical setup is already bullish. All the pieces are in place. The wild card is timing. Markets can remain irrational longer than you can remain solvent, as the saying goes. Gold could consolidate here for months before the next leg higher, or it could take off tomorrow. Nobody knows. But what we do know is that the fundamental drivers are in place for a sustained bull market. One thing to watch is the gold-to-silver ratio. Historically, when gold enters a strong bull market, silver eventually follows with even more explosive moves. Silver is more volatile, more industrial, and has a smaller market. When investment demand kicks in, silver can move much faster than gold on a percentage basis. Right now, the gold-to-silver ratio is elevated, meaning gold is expensive relative to silver. If history is any guide, this ratio will compress as the precious metals bull market matures. That means silver could offer even more upside than gold, though with more volatility. It's something to keep in mind as you think about positioning. Another thing to watch is mining stocks. Gold miners are leveraged plays on the gold price. When gold goes up 10%, mining stocks can go up 20 or 30% because their profit margins expand dramatically. but they also come with operational risks, political risks, and management risks that physical gold doesn't have. The setup in mining stocks is interesting because they've been lagging the gold price. Normally, miners lead gold higher as investors anticipate rising profits. The fact that they're lagging suggests either that investors are skeptical this gold rally will last, or that there's a massive catch-up trade coming. Time will tell. But here's what I keep coming back to. Gold is in uncharted territory with no resistance. That's not a common occurrence. It's not something that happens every year or even every decade. It's a rare setup that historically has led to explosive moves. The last time gold was in truly uncharted territory was in the late 70s, and it went from around $200 to over $800 in just a couple of years. Before that, it was the early 70s when gold was freed from the Bretton Woods peg, and it went from $35 to $200 in just a few years. Both of those moves were driven by fundamental monetary crises. Both were characterized by a loss of confidence in fiat currency. Both saw gold break into uncharted territory and then surge far beyond what anyone expected. And both made fortunes for people who positioned early and held through the volatility. We're in the early stages of what could be a similar move. The monetary crisis is unfolding in slow motion. The loss of confidence is building gradually, but the direction is clear, and gold is responding exactly as you'd expect it to. The question you have to ask yourself is, what's your plan? Are you going to wait for confirmation, which might mean buying at much higher prices? Are you going to try to time the perfect entry, which might mean missing the move entirely? Or are you going to recognize that we're in a rare setup and position accordingly? There's no right answer that applies to everyone. Your situation, your risk tolerance, your time horizon, all of these factors matter. But what I can tell you is that the people who do well in these situations are the ones who act on conviction based on sound analysis, not the ones who wait for certainty that never comes. Gold in uncharted territory with no resistance is a setup that doesn't come around often. The fundamental drivers are in place. The technical structure is bullish. Central banks are buying aggressively. Supply is constrained. And the geopolitical and monetary backdrop is supportive. This isn't about getting rich quick. This isn't about speculation. This is about recognizing a major shift in the global monetary system and positioning accordingly. This is about understanding that when central banks around the world are buying gold by the ton, they know something. They're preparing for something. And maybe we should be paying attention. The mainstream will catch on eventually. They always do. But by the time gold is on the cover of every financial magazine, by the time your neighbor is talking about it, by the time it's the obvious trade, the easy money will be gone. The time to position is when the setup is clear, but the crowd hasn't arrived yet. And that's where we are now. The setup is clear. The breakout is confirmed. The fundamentals are supportive. But the crowd is still skeptical. They're still waiting for a pullback. They're still thinking in terms of the old range, the old resistance levels that no longer exist. Gold is in uncharted territory. There's no resistance above. The path is clear. And the question isn't whether it's going higher. The question is whether you're going to be positioned when it does.